So good morning to the second in IUG's series on webinars. My name is Thomas Frankel. I'm a member of the faculty at IUG for now 7 or 8 years. I have a background in corporations. I've been working for the better part of 25 years in different corporations like Intel, Texas Instruments, or here CETA in Geneva. I created, co-created 2 companies, one in IT actually, and the other one in airports, specifically consulting governments how to privatize the airports. Okay, so what I'd like to discuss today is a topic that many of you, if not all, will find rather arcane, and that's corporate governance. In reality, it's actually a pretty interesting topic, but not one that you would normally associate really with management studies. Sometimes it's really part of the law departments of universities, but it's really, it should really belong to business studies. And I think at the end of the webcast today, you will certainly understand why. So as an introduction, really, I would like to talk about your Aunt Thelma, really. Your Aunt Thelma, this is a photo when she was much younger, actually. She sadly passed away, and you inherited from her a very nice office building shown on the right-hand side. Now, this office building, let's say it's in Balochistan, has only the best tenants and obviously is spanking new. And so that was a stroke of luck, right? You know, at your second or third meeting there, you realize that the rents in this office building are actually very low. They're like half of the market rents. And you say to yourself, well, I mean, these are all very well-known, very solvent tenants. You know, why would they not pay, you know, market rent? So you ask for a meeting with the tenant representative, and the tenant representative tells you, well, we understand that you would like to raise rents, but this is not the way it works here. We determine the rents, and we're perfectly fine with the rents the way they are. And you say, well, it's not possible. We're in a market economy, right? And so the tenant representative says, yes, sure we are. But, you know, the market economy really means if you don't like it, you can sell the office building and do something else with your money. So that's what you do, right? As quickly as you can, you sell this office building in Balochistan. And with that money, you buy majority stakes in a number of smaller corporations in Switzerland and America, in France, and so on. And you go to the first annual general meeting of those corporations in which you are a majority shareholder. And at the annual general meeting, what is this being discussed is the strategy of the company going forward and executive compensation. And you realize that the proposal the board comes up with is absolutely ridiculous. The compensation that the board is proposing to shareholders is completely out of whack with the performance of these CEOs, or the CEO rather, and the executive management team. So basically, you vote against that proposal, expecting that that's the end of the proposal. But then you realize that's not the end of the proposal. You just gave your advice. And it doesn't matter whether you're a majority shareholder or not. The board will just do what it proposes to do, right? You're just there to be present, right? And then you think to yourself, wow, you know, I came from Balochistan and invested my money in all these corporations, and you know, I don't even have a say, even though I'm a majority shareholder. And you think this was only the first AGM, but you go to the next third, the second, the third, and so wherever, it's always the same across the world. So welcome to the strange world of corporate governance. All right, so what is it that I would like to discuss in the 45 minutes that are coming? First, to give those who are not completely familiar with the topic an overview of what corporate governance actually is, then, you know, where boards are failing, what are the symptoms, why they're failing, Then I'm going to discuss CEO compensation, which is a major topic in corporate governance. Then I talk about governments and why they don't do enough to improve corporate governance. And then I'll talk about why should we care? Why is it not just only a matter between shareholders and boards, right? Why is it something that concerns us all? Finally, I'll talk about some of the recent trends in reforming corporate governance, which don't go far enough, which is why I hope that the current crisis may be a catalyst for change in corporate governance to get things right. So after that, there will be a Q&A. And so let me just start defining what corporate governance is. According to the OECD, it's essentially the principles, systems, and processes by which companies are directed and controlled. Now, if you really boil down to it, corporate governance is about making good decisions in the interest of the success and the long-term survival of corporations and their stakeholders. Now, in different parts of the world, good and success are defined differently, right? So you may be familiar with the shareholder-centric approach of the Anglo-American world and the stakeholder-centric approach of pretty much the rest of the world. So in other words, the shareholder-centric approach being the one where the interests of shareholder count and nothing else. And the stakeholder-centric approach is about, yes, shareholders are stakeholders, but there are other stakeholders as well. Now, the underlying principle of corporate governance across the world, irrespective of the different systems, is that shareholders delegate control to the board of directors. Pretty much like in a representative democracy, right? Every 4 years, basically, or could be 4 or 5 or 6, whatever, you vote the representatives, the parliamentarians that are then for the next 4 or so years, hopefully, deciding in your interest. Very similar principle in corporate governance, meaning that during the reign of the board of directors, you have essentially no way to decide on major aspects of the corporation. So what are those responsibilities of board directors? One is the strategy of the corporation, but then to make sure the books or the profit and loss statement and the balance sheet are accurate. So they oversee the external auditing, then risk management, the oversight of management, executive management, and the compensation of executive management. I'm not going to talk much about the first 3 today, but more about the oversight aspects and also about executive compensation as probably the most visible symptom of problems in corporate governance. So which are the principal actors? They are the boards of directors, who are very much like parliamentarians representing the interests of major shareholders. Well, of shareholders in general, but in reality, the bigger the shareholder, normally they would take into account their interests more than others. Which are major shareholders? Typically institutional investors. So investment funds are typically the major shareholder in the large corporations. And among them, pension funds are the biggest. Other principal actors are regulators, so the Securities and Exchange Commission in America or the FINMA here in Switzerland, and then lawmakers. Lawmakers because there are actually a few legal initiatives that affect governance. So, for instance, anti-corruption laws would be one, environmental laws, or the EU company law, and so on. But by and large, really, corporate governance standards and best practices are really not mandatory. These are applied voluntarily. And normally, corporations who elect not to abide by these standards really only have to explain why they don't do it, but they are free not to abide by, corporate governance standards. The basic underlying concept of corporate governance is the so-called agency theory. Now, whether you have had decades of experience with charming cleaning ladies like myself or not, you will probably be able to confirm that rarely a cleaning lady would cover in places that are not visible, like behind the cupboard, under the sofa, and so on, unless you tell her to do so. Why would she not do it normally? Simply because if she does all the work in hidden places, you may say to her, well, you haven't done much today, really, right? And you would suspect that she's just not doing her job, and you might change cleaning ladies, right? So I think we can agree with that principle. What has that got to do with corporate governance? Well, it has to do with corporate governance because CEOs and corporations typically have a tenure of 3 to 5 years, right? So why on earth would they spend money from the bottom line of the corporation to spend on research and development that will only bear fruit in 6, 7, 8, 9, 10 years, right? They have no self-interest in doing that as long as their pay is linked to the financial performance of the corporation, right? Which is always the case. There may be additional factors, but by and large, CEOs CEOs' compensation is determined by financial indicators like earnings per share, profits, after-tax profits, and so on. So the agency theory therefore says that the shareholders of a corporation have an interest in the long-term survival and success of the corporation. Hence, research and development is important. Innovation is important, right? But the so-called agents, the executives, have a different view because they have their own financial advantage in focus, right? Which is typically normal, it's human, right? So you do have a conflicting set of interests between the owners and the executives that have been charged by the owners to run the company, right? And that is the fundamental conflict in corporate governance, which is so difficult to, it's impossible to solve, but you can mitigate it. And, and as a result also from what I just said about the conflicting goals, owners and executives have a different attitude to risk-taking. The shareholders, the owners, are interested mostly about survival, successful survival over longer term. Executives are really only interested in their compensation. I'm sorry, this is confirmed by research. I'm talking about more psychology probably than business, but obviously both are very, very closely linked. So when I gave you this example of your Aunt Thelma in the beginning, basically, obviously the Balochistan part is fictitious, but the second part is real. You talk about certain symptoms of where corporate governance really is failing, right? And the most blatant one, in my view, is really the issue of executive compensations, which I will touch upon in a little more depth. But otherwise, what you see today, and of course I have to generalize because corporate scandals are, still fortunately exceptional, but I still raise certain principles you will find in all countries of the world, including, for instance, lack of oversight. Because one of the major tasks of boards is to oversee executive management. The Volkswagen scandal, the very recent and ongoing Boeing scandal, or Wirecard, it just basically happened a few days ago, are all lack of oversight of executive management by the board, or symptoms of such, if not worse. Then there are asymmetric risks and rewards. Corporate profits are always private, right? Whereas, as we know from the 2008-2009 financial crisis, catastrophic losses become public because they are the too big to fail corporations. And back then, those were banks. But arguably today, and not even only arguably, but what you see really is that many big corporations are too big to fail because of obviously the employment they have, right, or generate. Excessive executive compensation is, again, as I said, another one of those symptoms of board failure. Elon Musk recently took $870 million home, $870 million as his pay. This represents just about all the profits Tesla ever made, right? And that consists, that is his pay package. Because he has reached certain financial benchmarks, in that case, it was actually the share price of Tesla, right, which has gone through the roof. Now, you probably say to yourself, well, doesn't Elon Musk have a really, really big interest in boosting the share price, no matter what? And that exactly is what has happened. I mean, he's been caught lying about results a few times, and he was able to do it because the Securities and Exchange Commission chairman in the U.S. is a protege of Donald Trump, who obviously is looking quite favorably at Elon Musk. So you see the political elements here are quite major, really. And then another symptom of board failure is what's called Ponzi finance. And these are all the tricks corporations the legal tricks corporations can apply to boost their share prices, right? For instance, taking on loans to buy back your own stock, your own shares, and basically then cancel your shares. Why would corporations do that? Because one of the major determinants of executive payment is earnings per share. If you have fewer shares, but the earnings remain the same, your earnings per share will go up, which drives the share price, which is something that shareholders in principle also are happy with, right? So there's a kind of a collusion, and sometimes collusion, but sometimes also conflict of interest between shareholders and management of big corporations. The other one is financial reporting, or in the US specifically, the so-called non-GAAP financial reporting. So in other words, financial reporting that actually distorts the real numbers, also obviously in an attempt to look better than reality and boost share prices. And then finally, aggressive accounting are all those methods of accounting which are in a gray zone between legality and fraud. But since this gray area, specifically under GAAP, the US standard of accounting, has a lot of loopholes open, aggressive accounting is possible. So doing away with aggressive accounting would be a major way to improve corporate governance. Now, why am I making all these points about the share buybacks? Because numbers like this chart here by Deutsche Bank basically shows that the only driver of the rally in the stock market since 2009 has been corporate stock buybacks, right? You see that households have actually decreased their shareholdings. The foreign investors have kept them pretty much at the same level. But so this red line is all the non-financial corporations, so non-bank corporations who have bought their own shares to cancel them then in order to boost earnings per share and hence the share price. So the whole rally since 2009 is a bubble, you may argue, right? So why all this business around stock buybacks? And I don't want to go too much into the technicalities, but I think it's important to mention that, there are corporations that offer dividends, which was a traditional way to pay out profits to shareholders. They are still, as you know, dividend-paying corporations, but stock buybacks have become the favorite way to pay back to shareholders. How does that work? Well, because as I said before, when you buy back shares, you drive in principle up the share price, which is good for shareholders. And in many jurisdictions, you have to pay income taxes on dividends, but not on share price gains. But this is only part of the story, because the share buybacks are mostly done, again, in the self-interest of CEOs, because in an environment where profits are stagnant over the last 10 or so, well, depending obviously on the industry, but where share prices would go nowhere much without buybacks. Buybacks is a very popular way to boost the share price and hence the bonuses of executives. So this is especially when it comes to borrowing money from the banks in order to have the money to buy back your own shares. This is something that's in the interest of executives, but it is a very short-term thinking. In the longer term, this is something that hurts corporations because, of course, they will have to pay back those loans at a later point. So the Harvard Business Review, late 2019, actually found that the likelihood of buybacks done in a certain corporation is closely linked to, whether the flexible elements of the CEO compensation, like options, are soon going to vest. In other words, once the share price go up, the options will be worth much more, and that drives the behavior of CEOs, and that drives this phenomenon of stock buybacks. Okay, just to close the round of the symptoms of board failure, other reasons are that there's some sort of collusion between the boards and executive management. The directors of boards are very often former executives. The executives of big corporations know each other very well for a long time. They're not going to hurt each other. So if on your board is a former executive of another corporation and you run the corporation, there's a kind of buddy relationship in general, or just the phenomenon of old boys networks. But I'll talk a little bit about board composition in a little while. Then so-called trophy boards. Boeing is one example where I believe there were recently 12 board members, 11 of which had absolutely no previous experience in not even the air transport industry, right? But they were very prominent figures, right? Very well known, former hero CEOs. There was only one who ran an airline before, but airlines are customers of Boeing, so it's not exactly the same thing. So how can you expect those trophy boards to perform tasks like strategy setting, or any other task that relates to the long-term perspectives of a company if they have practically no knowledge of the industry in which they are a board member or the corporation? And then what are other symptoms? Well, so-called institutional investors I mentioned before, which just don't step up to their responsibility as major shareholders in terms of trying to steer the corporations that they obviously have big shareholdings in the right direction, or to oppose certain excessive behaviors. The agency problem exists at executive level. As I said before, it exists at the board level itself, but it also actually exists at institutional shareholder levels. Because if you manage a big pension fund, right, you're incentivized on the basis of your financial performance vis-a-vis certain benchmarks. But other aspects like environmental, social, or governance type of factors don't play a role for your compensation. So you also there have an agency problem between the operators, the managers of pension funds, and you and I, as those who are invested in those pension funds. Then you have the aspect of the fox guarding the hen house. Often the chairman of the board and the CEO are the same person. So how can you expect the chairman of the board to exercise effective oversight over executive management if it's the same person? Now, this is mostly in the Anglo-American world, but still, the Anglo-American world is big. Then when you look at who are directors on the boards of corporations, they're called typically as, or characterized as male, pale, and stale. They are on average beyond their prime. They're male. As I said, they're former executives in often unrelated industries. And what they do is they meet 4 to 6 times per year. So they cannot really exercise effective control given that so little of their time is spent on being a director in a corporation, which is why they are so-called professional directors. These are former executives who now are on the board of 10, sometimes 12 corporations, right? So, and then it becomes quite lucrative. They make about $150,000 to $250,000 per year, but just for meeting 4 to 6 times per year, that's not badly paid, right? And then finally, something I will discuss a little more going forward is the ineffective control of the board by the main shareholder, something I alluded to briefly already. Institutional shareholders have no incentive to exercise effective control. And shareholders cannot vote down excessive compensation packages decided by the board, right? As I used an example of Aunt Thelma, which again is not fictitious, it's the reality of corporate governance in the world today. So obviously, the political system, elected representatives, should exercise their power to rectify things. I mean, all the symptoms I just mentioned are, of course, well known for many years now. Now, we are in a special situation right now where the focus of governments is how to save the economy from the effects of COVID-19. And of course, the response by governments has been arguably much better, much stronger than in 2008, 2009 crisis. But what's often overlooked is that bailouts mean that shareholders are bailed out. It's not the employees, because if a corporation goes bankrupt, right, then it doesn't mean that all the jobs disappear. What it means is the shareholders get wiped out. Their shares are worth nothing. Private equity or other investors come in and buy the corporation for very little money and obviously maintain as much as they can the staff, right? So that makes it that governments have to be very sensible about how they use taxpayers' money when it comes to addressing the current situation. The other aspect of political failure is there is a often very cozy relationship between former political decision makers at high levels and institutional investors. Think, for instance, Manuel Barroso, who obviously was EU Commission President back in the day, is now non-executive chairman of Goldman Sachs. Philip Hildebrand, former SNB president in Switzerland, is now vice chairman of BlackRock. Francois Fillon also works now at a big, senior position in an investment fund. Former Australian Prime Minister Malcolm Turnbull as well, and so on. So if you basically have it that former politicians have the choice to join big institutional investors, then obviously their decision-making as politicians will be affected. They will not basically act in a way to reduce their chances of landing, these very well-paid jobs. So they would not look at improving the governance of those institutional investors. Then there's the issue, of course, and you're fully aware of that, of tax havens. That is a political issue, and that obviously governments in some countries, most prominently Bermuda's, Cayman, Ireland, Netherlands, and so on, also Switzerland, have created corporate tax havens and certain loopholes that allow corporations to legally minimize corporate taxes. And there's the losses of using those loopholes, according to the OECD, amounts to $240 billion annually. This money obviously would be very handy to now contribute to solving the effects of the crisis, but it's not there. Okay, let me cast a little more light on the CEO compensation without, and I'm mindful of the time. So executive compensation has been pretty much stagnant for the 30 years following, 25 years following World War II. It was always around 1.5 million or so, and then it went through the roof, right? This is from London School of Economics, basically shows that from 1975 or so, it went through the roof. Now, the base pay remained pretty much at the same level, right? Whereas what did go up was, the bonuses, right? So, for instance, the award of options or long-term investment plans and shares, right? So the flexible element of payment, went up very strongly, whereas the base salaries remained the same. The underlying principle is a good one. You want to pay according to performance. So performance will be reflected in the financials. The financials will drive the share price up, meaning that executives will be compensated through a rising share price. The downside, of course, is that they have an interest in driving up the share price at all price, and not necessarily in the interest of shareholders. So how does it look? There's this report coming out every year on the most overpaid CEOs. Overpaid means as compared to the performance of their corporations, right? Not just in absolute terms, and also in terms of how much more they make than a worker at that same corporation. So I mentioned the most blatant recent example, Musk, and all these people here pale accordingly. But the co-CEOs of Oracle make a combined $216 million per year, and so on. I don't need to go into the details to demonstrate that this is excessive. If a CEO makes 3,000 times more than a worker at the corporation, things are not, they're out of whack. Now, the irony is that the more overpaid CEOs are, the less they are performing. So increasing compensation beyond a certain point is counterproductive, probably because, and that's my interpretation, that CEOs feel comfortable and they feel that the board is on their side. The board is proposing those excessive compensation packages, meaning the board will also not be terribly harsh in terms of overseeing, the performance, the operational performance of the CEO. So overpaying CEOs is not a good idea for shareholders, but there's a reason why it's happening. One reason is that, the big institutional investors don't even vote down those excessive pay package proposals that are tabled at the annual general meetings, right? Now, BlackRock, as the biggest one, rarely ever votes against these excessive pay packages. There are some exceptions here, but you see, these are the real big institutional investors who really have weight, right? Whereas the smaller institutional investors are much smaller, right? They vote against pay packages a lot more often, right? Now, the problem, of course, is they are, comparatively speaking, small, and so their voice is, just not as relevant. Now, you may say, well, if that kind of vote is only is not binding, why does it matter? Well, because it just does not look very good if 60% of shareholders present at an annual general meeting vote against a pay package, right? And normally, that means that the boards are forced to do something about it, but legally they're not forced to do something about it. Why does it all matter in the bigger scheme of things? Well, the big topic is income inequality, and you see the US, and that's also where excessive compensation happens most, at the very top. And we know that, right? Income inequality is a big social issue in the US. And hence, excessive compensation is part of the political discussion around income inequality. And what exacerbates the issue is that executive pay, the red line here, has gone up so much since the 1960s, whereas blue line, average worker pay, has essentially remained flat, accounting for inflation, right? So the gap between excessive or compensation of executives and workers at the same corporation has increased all the time. Now, you may agree that say, well, this doesn't look good, right? But in the end, is it not just about shareholders being taken advantage of by boards, right? Why should I care, right? Well, the thing is we all have to care because your Aunt Thelma could sell the office building, right? Because she was not happy with the situation of not being able to, decide the rents. And that's the argument that's normally voiced, that if you, as a shareholder, you don't like what's happening, well, just sell your shares, right? Invest it in bonds or so. But that's of course true. But so much of our personal wealth, as people who pay into pension funds, is locked up in pension funds, and where we have absolutely no way to decide what the pension fund managers are doing, and also what they are voting on at AGMs, right? So here, according to the OECD, on average, 25% of the holdings of a pension fund are invested in equities, right? So that, given that pension funds are the biggest, typically, investors in corporations, that means it's a lot, right? The other aspect is that the voting rights at AGMs are really linked to, obviously, the amount of shares an investor has under management or owns. Now, there are some kind of investors who are not really investors, they are speculators. And share trading as speculation, obviously, has become so much more prominent over the last decades. In 1960, for instance, the average shareholding of a share on the US stock exchange was 8 years and 4 months. In the year 2000, it was 1 year, 2 months. 2019, well, your guess, it's 22 seconds. So these are meaning that stock markets are so much influenced now by these high frequency traders. On the other side, high frequency traders simply because they hold stocks only for such a short time, obviously don't exercise voting rights at AGMs, which gives more voting rights and more voting power to institutional shareholders. Another reason why institutional shareholders should exercise their powers. So, as we come closer to the end of this session, there are some encouraging signs of changes in corporate governance. One is that you see more and more boards who actually become involved in shaping company strategy, rather than just rubber stamping whatever is presented to them by the executive management to, agree with. So they're taking a more active role in the important parts of governance. Also, shareholders more and more demand that directors and top management own significant stock. In other words, with their private wealth, buy shares in the companies they run, principle of skin in the game, and not just becoming owners of shares through their compensation plans. Then you see actually more women and minorities represented on board, even though that picture is very different from one region to the other. Nothing has happened in that respect in Japan, for instance, but in Sweden, you find already pretty much, male, female directors represented at an equal ratio. So, in some parts of the world, things are changing. Also, the directors of boards are sometimes now evaluated, their performance is evaluated, and consequences are taken if performance has been missing. Boards have become overall smaller, easier to manage. I'm sorry. The roles of chairman and CEO has been splitted in many cases, like in the case of Boeing. But the biggest issue, arguably, is that the big shareholders, pension funds, don't exercise their voting power in the interest of their constituencies. You and I. It has not been addressed. So, what is a vision for a more responsible corporate governance? And obviously, at the top, in my view, is pension fund accountability. So the principle that pension fund managers should be obliged to take into account not just the financial interests of their constituencies, but also the interests of society at large because they are so powerful. So the principle of environmental, social, and governance voting. Then ESG investing should include voting on executive compensation packages. So the G part in ESG should mean that there should be a binding vote on executive compensation packages. Then the performance of pension fund managers should be measured on what's called a triple bottom line basis and not just financial performance. So, I don't think I need to go too much in the interest of time down this list. Let's maybe look at also the principle of direct shareholder democracy. We here in Switzerland have a direct democracy, meaning that we can vote on certain initiatives and not having to wait for those 4 years to expire to basically vote down representatives whose performance we don't like. So the principle of direct shareholder democracy should be instituted. Now, why do I raise this in this context? Why has that not already happened if this is such a great idea? Well, simply because all reform in corporate governance has really ever happened in times of crisis only. Why is that? Because political constituencies, don't really care about these aspects if everything seems to go right. Only in times of crisis and when corporations and the acts of corporations come under the limelight, in terms of taking certain risks they should not have taken and then asking for bailouts, then the public is alarmed. And that's why this is a time where corporate governance has a chance to be reformed. Also because bailouts basically means that there's a shift of power from the private to the public sectors. If the public sector, if that comes through, becomes a 25% shareholder in Lufthansa, that means now they have an obligation to actually impose ESG factors into the governance of Lufthansa. And it's not just Lufthansa that is being supported by governance, other airlines, but then Boeing and so on. So the public sector will have more power, and they should exercise their power in order to do away with this aggressive accounting that is happening so often, do away with leveraged stock buybacks, which should be banned, make shareholder votes on compensation packages binding, introduce ESG goals in CEO compensation, and then finally make fund managers accountable for the role as controllers of corporations. So to close, just two quotes, one from Adam Smith: "No society can surely be flourishing and happy of which the far greater part of the members are poor and miserable." And Amartya Sen, who is obviously a Nobel Prize winner in economics, said, "The invisible hand of the market needs to be balanced by the visible hand of good governance." Okay, with this, I close the presentation part of the session today. I will now stop present, and I will also turn off the recording.